Hi, this is Dr. Bear. Today we are going to actually look at creating the transactions that end up being the information that flows into your financial statement. So if you watched my other videos, I've kind of been leading up to this video in the other ones by explaining what the process of accounting is, introducing you to the accounting equation, going through a detailed explanation about how debits and credits work. And so now we're going to start putting all of that information together into the whole process of capturing the financial information of a company and creating the financial statements so that you can present this information to the users that need to see it. I apologize up front that this is probably going to be one of my longer videos because I have a lot of information to go through and to get to. So please bear with me. I think that you'll find a lot of important information in this video. The first thing you need to understand about an accounting system is the chart of accounts. So every accounting system begins with a chart of accounts. You can think of this as like the table of contents. So if you're reading a book, you have the table of contents that basically gives you a summary indication of what is contained in the book. The chart of accounts is the table of contents for your accounting system. It lists all of the accounts and their account number that are in your system. Now, some of the things that you need to understand about a chart of accounts is the way it is laid out and presented. Generally, the chart of accounts is going to list all of your asset accounts first, followed by your liability accounts. Then you'll see your equity accounts, then the revenues, and finally the expenses. And you'll notice the numbering system as well. Asset numbers in a accounting system generally start with a 1. Liabilities will start with a 2. Equity accounts will start with a 3, the revenues with a 4, and the expenditures with a 5, 6, 7, 8, and so on. Your account numbers may look very different from this. They could be a lot longer. They may be 5 digits or 10 digits, and they may have department codes buried in them. But this is just a very summarized, high-level overview of what a basic chart of accounts looks like for a company's accounting system. Now, if you were to go to the page within the system for an account, this whole system, all of the pages contained in the system are referred to as the general ledger. You've probably heard the general ledger talked about on your job. If you haven't, you will. If you're going into the field of accounting, you'll become very familiar with the general ledger. But the general ledger contains all of the accounts in your system and all of the data, all of the debits and credits that have affected each account and what the ending balance is in each account. So for instance, if I went to the page in my general ledger that had my cash account, I would see all of the debits and credits that have been posted to that cash account, and I would be able to see what the current ending balance in that account is. You can think of that as like your checkbook, where you're tracking all of your deposits and all of your withdrawals. Every account in your accounting system, in your general ledger, is going to contain all of the debits and credits that have been posted to that account and the final current ending balance. The process of capturing and recording this information begins with a journal, not the general ledger, but a journal. The journal, you can think of this as like a book that's going to detail each transaction as it happens. You're going to post the date of the transaction. You're going to tell what accounts this transaction is affecting by listing the account title. You will have some sort of a source document that it came from that you'll notate here so you can always refer back to it, a posting reference for how it's posted in the system, and whether or not you are debiting that account or crediting that account. Now let's go into a little bit more detail here about this process. When you think of a current accounting, a computerized accounting system, all of these types of things are recorded within the system itself. You're not going to see a page that really looks like this. You could run a report in that system, a general journal report that would list the transactions that might look similar to this. But as far as seeing this on a day-to-day basis in an accounting system, you're not going to see this. A lot of the things that you're learning in an accounting classroom are related to how accounting was done back in the not so old days when you were doing everything by hand. You're going to learn the manual by hand process so that you can understand the process of the flow of the information in an accounting system. The journal is going to capture the information in a chronological order from the date that it is posted into the journal. Source documents of where this information comes from is a variety of places. You have checks that are written, those are source documents. You might have calculator tapes where someone has calculated an amount that's been posted into the accounting system. You have receipts from your point of sale system. You might have other types of memorandum where this information is coming from that ends up getting posted into your accounting system. But we're only talking about items that have a monetary effect on your business. That's what you're capturing in your accounting system. You have to analyze each of these transactions and determine what accounts they are affecting, whether the account is being increased or decreased, whether or not it needs to be debited or credited to affect that change. And if you did not watch the video on debits and credits, please go back and watch that one because I go into great detail there about how debits and credits affect the different elements in the accounting system, and you need that basic understanding to be able to understand what we're fixing to discuss here with posting transactions. After you have posted transactions to the journal, you're going to transfer those into the general ledger. So for instance, if I had a list here of 3 different accounts in my accounting system, maybe I had a debit to my cash account where I made a deposit, maybe I had a credit to my sales revenue where I received money from a customer, and another transaction here. You're going to take that information and post it to your general ledger. So I would go to the cash account page in the general ledger and post the amount of that debit. I would go to the sales revenue page in the ledger and post the amount of the credit that I had made, etc. So let's take a look at what that looks like. Let's look at some actual transactions. Now, I've got a lot of information on this spreadsheet, and it's going to look a little confusing to you, so just give me a second to kind of go through it and break it down for you step by step. The first thing you're going to see here is I have this information here posted into a nice worksheet. A worksheet is another great teaching tool, but they've become obsolete in today's world because accounting has become so computerized. You're not doing it manually. But back in the day when we were doing things manually, having a worksheet to post our information into was very helpful for gathering and summarizing the data as it was occurring. So you're going to see these in an accounting classroom. You may be even asked to complete a worksheet. This is just a very simple worksheet. It's not a detailed worksheet that has the adjustments to the accounts and then the other information that you're going to see on a worksheet in your classroom. But it's just a very helpful tool to see how information is broken down. And we get back to this accounting equation and keeping the accounting equation in balance. Assets equals liabilities plus equity. And if you watched my prior videos, we talked about how you have to have at least one debit and at least one credit in every transaction. Whatever you do to one side of the equation, you must do to the other. So if I'm increasing here, I have to increase here. If I'm decreasing here, I have to decrease here, unless all of the activity is only happening on one side of the equation. And we're going to see that in some of these examples here. So I have some examples here of some actual transactions. If you watch the prior video on the financial statements that I showed you, these are the transactions that occurred that actually ended up on these financial statements. So I'm going to take you through this step by step. So the first transaction is we began operations by opening a bank account for the quilt shop. We put $15,000 in the bank. That's a debit to my bank account for which is in my assets, and a credit to my equity. So I've increased the balance in my bank account. I've increased my equity into the company because I have invested money to start this business. The second transaction, we purchased equipment for $7,000 from the bank. So I bought some equipment. I paid cash for it. I'm reducing my cash, which would be a credit. I'm increasing my equipment, which would be a debit, because both of these are assets. Again, my accounting equation remains in balance. On the third transaction, we purchased office supplies for $300 on credit. In this instance, we're treating our office supplies as assets until we use them. So these are not going to be expenditures. Now, some companies might treat office supplies as expenditures. They don't post them to their assets and then reduce the asset and post the expense as they're used. They go ahead and and expense them right away. But in your accounting classes, whenever you're looking at supplies, most likely you're going to see them listed as assets. So treat them as such. You'll list them as assets, and at the end of the period, you will count and see how much of those supplies you've used, and you will transfer that using up of those supplies into your expenditure. So here, I'm buying them on credit. That means I'm not paying for them right now. I owe a creditor for this. So I'm increasing or crediting my liabilities, and I'm increasing by debiting my supplies and my assets. The fourth transaction, we've received revenue from the sale of quilts. So our customer bought some quilts and paid us. We increase our cash. We increase our equity. Remember, your revenue has a direct effect on your equity. It increases it. All right, in the fifth transaction, we billed a customer for $1,300 for purchases that were made during the month. So if we've billed our customers, that for us is an accounts receivable. That's money owed to us from a customer, which is an asset. That's our debit. Our credit goes to our revenue. Customers bought something from us. Even though they haven't paid us yet, we've still earned this revenue. That increases our equity. Transaction 6, I made a partial payment for $50 on these supplies I purchased up here. So now I'm paying $50 towards this $300 liability that I have right here. So I end up with a credit to my bank account and a debit to my liabilities. Both sides of my accounting equation are decreasing. Let me do this really quick here. Freeze my pane so that you'll be able to continue to see this data as we scroll down. Okay. Transaction 7, we paid our rent expense for $1,200 for the month. So we're reducing our cash, we're increasing our expenses, which reduces our equity. Remember, we talked in one of the first videos about the increases to expenses being debits, which cause a decrease to our equity. Here I'm withdrawing $1,000 from the company for my personal use. So I'm reducing my cash. I'm reducing my equity. We paid a monthly electric bill, so we reduced our cash. We reduced our equity. This is your credit. This is your debit. You paid a telephone bill for $100. Again, we reduced our cash with the credit. We increased our expenses, which reduced our equity with this debit. And you'll notice here how all of the assets added up equal to $15,950 are equal to the liabilities plus the equity added up. So my accounting equation remains in balance with all of those transactions. Now, again, this is just a teaching tool. When you're actually entering transactions, this is what they're going to look like over here. So this is how you would actually record transactions. You are going to record the debit first. Always record the debit entry first. The credit entry is going to be slightly indented. So here is where I made the investment into the company. I debited my cash. I credited my equity, increased both sides of the accounting equation. Here's where we purchased equipment for cash. We've increased our equipment. We've decreased our cash. This only affects one side of the accounting equation. We have an increase and an equal decrease to assets. The third transaction, we bought those supplies on account. Remember, we didn't pay for them when we purchased them. We owe for them later. So we've increased our asset of supplies. We've increased our liability, money that we owe a creditor. So this is my debit. This is my credit. We received revenue. We received cash from a customer that bought one of our items. So we've increased our cash. We've increased our revenue. This is my debit. This is my credit. This is increasing, crediting my equity, increasing by debiting my bank account. Accounts receivable. So a customer, again, bought something from us, but this time they didn't pay us. They're going to pay us later. And accounts receivable is like an IOU from our customer is an asset. So I'm debiting my assets to increase them. I'm crediting my revenue to increase the revenue. Accounts payable. This is where we made the payment on those supplies. So I am decreasing my cash with a credit. I am decreasing the accounts payable, which was the liability where I owed money to my creditor. And then the last three are just payment of our, I'm sorry, not the last three. This is where we paid the rent. We have the increase to the expenditures. which reduced our equity, and the reduction to our cash. Then here's where I withdrew money from the business. I took out $1,000, so I reduced my equity with a debit. I reduced my cash with a credit. And then the last two are just payment of expenditures. We're reducing cash in both instances with credits. We're increasing expenditures, which reduces our equity with these debits. Now, it takes a lot of practice, and it takes time for this to sink in and for you to be able to practice, these transactions when you're doing accounting homework. So if it's confusing for you in the beginning, don't try to not let yourself get frustrated. It's going to take time, especially for the debits and credits part to sink in. That's why I told you that debit and credit video was so critical. And if you haven't viewed it, please go back and do that. A couple of tips, though, that I can give you that might be helpful is whenever you are recording an expense, it is always going to be your debit. Whenever you are recording revenue, it is always going to be your credit. Whenever the owner is withdrawing money from the company, it's always going to be a debit for that withdrawal account. So there are some little tips like that might help you when you're analyzing transactions if you can at least remember what is going to be the debit side or what is going to be the credit side. You can figure out what the other side of the transaction is. Now, T accounts. You're going to hear the term T accounts, and you're going to become familiar with those because you're going to be asked in some of your homework assignments to create T accounts. So a T account basically is the exact same information we've just discussed over here and that we discussed over there. It's just another format. So the T account is going to mimic what the general ledger looks like. You're going to have a separate T account for every account that's located in your general ledger. And you're going to take all these transactions you've created and you're going to post them into your T account. The left side of the T is for debit entries. The right side of the T is for credit entries. So if I go and I find all of the entries to my cash, so we can see them here, I'm going to post them. Here is a debit to my cash for $15,000. Here's a credit to my cash for $7,000. Here's another debit to my cash for $2,200, and so on. If I go down through every one of these transactions and I post that entry to the account, and I do it for every one of these. So over here is the accounts receivable from my customer owes me. Here's the $7,000 for the equipment. Here's the deposit in the very beginning where the owner deposited $15,000 to start the business. There's the $300 in office supplies I purchased, and so on. You're going to capture all of the debits and all of the credits for each account. And when you're done, you're going to add up the total debits and add up the total credits and figure out what the ending balance is in that account. So if you add up total debits and you add up total credits and you subtract the smaller number from the larger number, that's the ending balance. And whatever side has the larger amount is going to determine whether you have a debit balance or whether you have a credit balance. And if you go back to the video I posted where I talked about the accounting equation and we talked about the normal balance of an account, assets on the left side of the equation normally have a debit balance. Liabilities and equity accounts on the right side of the equation normally have a credit balance. Revenues normally have a credit balance. Expenditures normally have a debit balance. Whatever increases the account is what its normal balance is. Now, the last item before you get into creating the financial statements that you need to do is create your trial balance. So the trial balance is just a summary of all of the accounts and what their ending balance is. So once you've done these T accounts, you can go over here and grab these ending balances and you can transfer them to the trial balance sheet. So my ending balances in my cash account was a debit balance of $73.50. My accounts receivable has a debit balance of $1,300, and so on. And here's my credit balances for my accounts payable, my owner's capital, my sales revenue. So again, these are going to be listed in the same order as your chart of accounts. These are all of my asset accounts. Here's a liability account. Here's my two equity accounts. And then the revenue and expenditures are going to be listed separately but at the end of the accounting cycle, which we will get to in a later video, this is the money, the income that's going to roll up into your equity. So over here on the financial statements, we will see that. So just for the purposes of helping understand the flow to the financial statements, I'm going to copy this and bring it over here with me to these financial statements. Now, we looked at these in the last video that I posted. The other thing I want you to notice about the trial balance is that total debits must be equal to total credits. If those two columns are not equal, you have an error somewhere, and you need to go back and figure out where you made a mistake. If you keep the accounting equation in balance and you have a debit and a credit for every transaction, and the total debits must be equal to the total credits, then there's no way your trial balance is not going to balance unless you've made a mistake or you've transposed something or you recorded something to the wrong side. Now, again, in a computerized accounting system, all of this is going to be created at the touch of a button for you, but for the purposes of learning accounting, you have to learn this manual process to understand the flow. Now, once you've got all of your data summarized on your trial balance, you can create your financial statements. So you'll notice here on my income statement, I've listed the revenue, and we've listed all of the expenditures, and we've calculated what our net income is. And again, if you watch the last video, you notice that your net income is recorded onto your statement of retained earnings. And on this statement, we're also going to capture this owner withdrawal right here, this $1,000 that was removed from the company to get our ending statement of retained earnings. Now, I'm going to grab this and copy it so we can scroll down. So, enough so we can see. And your statement of retained earnings, again, is part of your equity. It flows into your equity account. You transfer that balance here. But the remainder of these items that were here on your trial balance make up the rest of your balance sheet. We have our cash balance. We have our accounts receivable balance, the balance in our office supplies, the balance of our equipment. That's our total assets. Then we list this liability. We list the investment that the owner made right here. And the rest of this all came from our statement of retained earnings and our income statement up here. It's already captured in this number right there. So if I add up my total equity, I get $15,700. And if I add that number to my liability, I get $15,950. And you notice assets and liabilities and equity are equal. Just like the accounting equation, the assets has to be equal to liabilities plus equity. That's the basics of how the process works. Now we're going to, over several videos, go through more in-depth information, more complicated information. This is just all very simplified, just to show you and give you an idea of the process and how it works. I hope this is helpful for you as a very beginning. Again, do not get frustrated if you're confused, and because it's going to take practice and it's going to take time. Please come back and watch more videos, and I'll be happy if you send me questions. I'm happy to answer questions, and I'm happy to create videos on other topics, and I will be creating more videos. So stay tuned, and I hope that you will